CMAP or mortgage live stream, we'll call it what you like, really. This is our Monday morning 12 noon update for you on everything to do with mortgages that's come on the last week, really, and new updates and new things that have occurred. So I'm Paul Archer. Let's keep you informed. Now, today, I've got a couple of topics for you. I'm going to talk about long-term care, really. It'd be rude not to, because it was in the news last week, so it'd be right for us to talk about how it is for mortgage advisors, mortgage brokers. And then I want to give you an update on our CMAP autumn cohort starting on the 4th of October, which I'm very excited about. New camera today, new technology using Vimeo now for live streaming, which is very, very good. So we just keep upgrading, improving our technology. Okay, let's talk about the long-term care side of things, shall we? The Britain's care reform, which was in the news last week, as you know, announced by the government. And it's a good thing, you know, because we're all getting older. I mean, I'm 58 this year, so I suppose I could be construed as old. But the point is, though, when you talk about people over the age of 65, which is the old-fashioned retirement date, isn't it? There's a lot more of them around there than there ever used to be. I mean, the numbers, the stats have all been done, haven't they? You've probably seen them. In 2011, for example, the number of young people to old people was 4 to 1. So you had 4 young people between 16 and 65 for every 1 old person age over 65. So young people obviously pay national insurance, taxation, etc., towards looking after the old people. Now, they reckon from 2028, it's only, 5, 6, 7 years away, it's going to go down to 3 to 1. So 3 young people, 1 old person. So the old people are getting old and there's a lot of them. They need looking after, and that's the problem. There's a big strain on the National Health Service, as we're aware of. So let's just take a look at what's going on then, put some numbers on the board and all those good things, shall we? So let's flip over to the camera here so you can see the whiteboard. Now, as you know, the government pay for care via the NHS, which is a brilliant system, best in the world, I think. And we contribute a lot of money through national insurance and income tax to pay for the NHS. And currently, if somebody gets too old and they need care, I mean full-time care in a care home, then the council or the government will pick up the bill when people's assets get to below £23,250. So when you're down to your last 23 grand, the state will pick up the bill for your long-term care. And if you've got any assets, if you're worth more than that money, that has to be used to pay for it. Whether you agree with that or not, that's the current system. And it's unfair for a lot of people. They have to sell their homes, and usually the kids who are going to inherit the home get more upset than the old person. But no, that's another issue, isn't it? But the problem is, of course, that all he's paying for, that's the key, and the government have decided to try and improve it. They've done all sorts of things in the past, deal not to report, etc., to try and solve the problem. Whether they've solved it or not, I don't know. But what they're doing now is they're capping care costs and they're helping people out a bit more than normal. And I'll look at the figures for you in a second. So from 2023 onwards, so we're talking about a couple of years away, they're going to change the way that the care costs are capped, etc. So it's going to be slightly easier for people to budget for this. And that's the key. When it becomes easier to budget, it's easier to plan. And that's when mortgage advisors and financial advisors come into their own. It's going to be paid for by national insurance going up. So let's have a look at some of the numbers, shall we? It's going to have to be paid for. So you're going to have to pay for this. It's not free. There's nothing in free in life. The grand don't come for free. This was once sung in a famous album a few years back. And national insurance is going up. They're going to call it the health and social care tax in a couple of years' time, because that's what they do on the continent. They have different taxes for different things. But national insurance contributions, your NICs, are going up by 1.25%. from next April 2022. So beware of that. Make sure you check your tax sheets if you're doing an exam. Now, the clever thing is clever, is that national insurance, of course, is paid for by employees and it's paid for by employers, but they're also going to get people over the age of 65 to pay for it, because when you retire, 65, 66, you don't have to pay national insurance. Not a lot of people know that. But they're going to make sure these people pay for it as well. Hence, of course, they're changing it to become a health and social care tax. But that's great, everyone's paying for it. But they're also increasing dividend tax, divs. Divs tax are going up again by 1.25%. Now, I think the argument to that one is that so many people pay themselves dividends now. So company directors, small business owners, they have a limited company. I'm one myself. And we pay ourselves dividends as well as a salary. So a lot of those people keep their NIs really, really low. So they should pay this through their dividend tax. And that's what the government are doing. They have a bit of a hoo-ha about it, but I think it's quite fair to do that. It's going to be paid for. So what's actually happening then? What's it creating? Well, in a nutshell, they're going to cap care costs. So let's just take some pictures here. Let's just draw some diagrams of what's happening here and how much is going to be paid for. Again, everything's changing, so don't take the numbers for red because everything's going on, lots of changes going on. So let's just take a look at a couple of people, shall we? We'll take a look at this dude here. This is a picture of a dude here, there you go, who is fairly wealthy. Are they rich? Probably not, but they're buying a house, and the house is, let's just put a property in there for you. They're buying a property. And the property they're buying is capped at, it costs £186,000. Just an example for you, and just a reasonable type property. And this person becomes too old and they need looking after. Therefore, they're going to have to pay or some kind of care costs involved. Now, what the government have said is they will cap the care costs now at £86,000. So your personal care costs are going to cost £86,000. Let's put that up there for you. 86 grand. They'll cap it. In other words, you only have to fork out that amount of money for your personal care costs. Doesn't include accommodation. That's just the care costs. That's the nursing fees, etc., which actually are the most expensive part. Of course, they are. The accommodation's not very expensive at the end of the day. But if you combine the two, that's why care home costs are very expensive. So if you think about it, this particular person who's got a house, say that's their only assets they've got. So effectively, therefore, if they were to use the house, they would have to take some money out of the property or probably sell it, and they would be able to keep £100,000. There you go. That's theirs to keep. Ta-da. So arguably, therefore, there's a bit of money for their next of kin. 86 grand goes towards paying for the care costs, because after that, the government pay it for you, because that's the cap. Now, accommodation costs come into it as well, but we'll talk about that another time. Now, let's just take somebody who's like mega rich. Let's just take another dude over here. And this particular person, let's put them in there for you. Enjoying themselves. They're mega rich, and they've got a mansion, say. This mansion is a lovely property. And there you go, there's the property. And let's say this worth a cool million. There you go. Cool million. So they can afford a lot of money, this person. Good for them too. Again, you see, the problem is they'll only have to take £86,000 because that's the cap that the government said they're going to cap care costs. So effectively, they've got 914,000. There you go. Okay, for them to keep, or their next of kin. So, is it fair? Bit political, I suppose, isn't it? The one-off figure, of course, affects the poorer person more than the rich person. Arguably, at the moment, of course, the rich person has to pay it all, but there we are. That's another story for another day, isn't it? So where does this come into? Where does this help financial advisors? I want you to start thinking about this now, because I know I've been putting my thinking caps on over the weekend, because I think as a mortgage advisor, something like that, this is actually quite useful stuff. So if we get rid of our property, let's get rid of our rich dude there on £1 million. Well, £1 million actually is not a lot of money for a property these days, is it? And let's just take a look at what happens when you are advising on a mortgage. So you're giving advice on a mortgage, and you're talking about protection, because good advisors do that, don't they? So you've got your property, and you're advising this to somebody who is whatever age, doesn't really matter, and they're taking out a mortgage, and you're giving them protection. So typically you would advise them on some life assurance, wouldn't you, for the mortgage itself? You probably do some income protection insurance for the mortgage itself, or to protect their salary. But this is good protection, of course. You'll probably do buildings and contents as well. Another policy for you. The whole point, of course, is this, and obviously a mortgage, you're going to lend them some money as well. So let's put the mortgage in there. So it's like a mortgage package. It's a full service package, which we give advice on to help people buy their home and keep their home. This is the key part here. Keep their home forever until they die. And if they do die, their next of kin's looked after if they've got dependents, that sort of thing. That's what we like to do. Now, bear in mind, care costs are coming into their own now, and the government have capped care costs now. There is an element of being able to cover yourself for this, you see, because the government capped the amount of money you've got to pay, and beyond that, they pay. And they're paying for it through all this national insurance. So, you are paying for it inadvertently. But now you see you can start to plan for that. Because what I would do is I would say to a customer who might be in their 50s or whatever, did you realise that at some point, some of your property is going to have to be taken away to pay for your care costs? At the moment, the government are capping at 86,000. In other words, you've got to pay the 86 grand yourself. There are limits, of course. Below £20,000, your assets, you don't have to pay at all. But I'm talking about people with property here. Then you're going to have to take some money out of your property to pay for your care. And that might be somebody coming into your home to look after you. That might be you going into a care home where you'd have to pay some accommodation costs as well. So I think there's going to be a rejuvenation of long-term care policies as well. I can see them coming back into the market. If you haven't looked at long-term care policies, Google them. They ain't around because insurance companies are really, really worried about them. But a long-term care policy is an insurance policy where you pay typically a monthly premium into this plan. And when you need long-term care, the money comes out, goes to the care home, and there's tax-free as well. So it's pretty good. You have to be able to be diagnosed as needing care, and the policy pays out. So I reckon this kind of policy is going to become quite popular if the insurance companies bring it back in. The insurance companies haven't had it because there's never really been a cap on the amount of money you've got to pay. Okay, if you're down to your last 23 grand, then the government picked up the costs for you. But for anybody with more than that, great big property, you could actually end up paying for all yourself. That's all changing. Now there's a cap. So what you do is you insure yourselves for the 86 grand. I can see that being quite a regular, popular policy. And you can sell it amongst the mortgage, as long as you're qualified to do so. I don't know what the qualification rules on that are, but you need permissions. So you're protecting the home in all situations happening, and also for long-term care, you're protecting the home. There's also nothing to stop you talking about equity release at some point as well. Equity release at some point in the future might be an option to release equity to pay for your long-term care. And then once that's paid for, the government picks up the rest of the bill. So you could probably stay in your home, not have to move out of your home into a care home if you have nursing care coming into your house to look after you, because you equity release the money you need without leaving your home. So there's plenty of opportunities for us, really, if you start to take a look at it. So the key thing is to plan for this. Get yourself qualified in equity release, definitely. Get yourself qualified in long-term care advising, if a lot of your clients are older as well. Definitely, that's going to be a massive growth area in the next few years. Now that the government are trying to tweak and fix the problem, they'll embrace the private sector to come in to help people out along the way. So there's a few ideas for you to make you think about it. It's opportunity. It's good. It's good stuff. And that's what our industry focuses on. I hope that's been a useful update for you. Bye. Okay. Hope you enjoyed that. Makes you think, doesn't it? About care. Keep your eye out what's going on in the marketplace. Keep your eye out what's happening. Check the small detail. National insurance going up. People will moan about it. Of course they will. Everybody is. Everyone's saying, "Oh, I'm not going to employ anybody because I have to pay for it." The fact is, it has to be paid for. Nothing's free in life. And if the government wants to solve the long-term care problem, then it's going to have to be built up some money to pay for it. And of course, the NHS needs boosting as well, because they've had a torrid time in the last few years, haven't they, with COVID, etc. Okay. Last point for you. Let's talk about what's coming up in October CMAP for you. Now, as you know, we here at Arch Training provide some really good CMAP training, have done for years. Now, we've niched our marketplace because we've gone online, have done for a few years now. We don't do classrooms where people go into a room and you get somebody at the front with PowerPoint talking to you all day. That's not how we roll. We've produced online learning. We have this thing called cohort system. And we've got a new cohort starting at the beginning of October. So on the 4th of October, we've got our autumn cohort starting. Now, I'm very excited about our cohort system because what it does is it puts 25 people in kind of like a group. up to 25, no more than 25, into a group. And what I do personally is I help those people as much as I possibly can to become CMAP qualified and hence become a mortgage advisor and a financial advisor too. That's really my aim and objective in my life at the moment. And that's what I like to do. So how does it work? Well, first of all, we want to make sure these people are looked after. So we give them lots of extra attention. It's lots of coaching, lots of live support, and lots of online learning. So what happens as soon as you join the cohort system, we give you access to our online boot camp, as we call it, our CMAP boot camp, which has been around for a few years now. It's very, very popular. It's all online. You log on to a system which is all nice and modern. You can use your phone, you can use your laptop, tablet, whatever is your preferred method. And you get 12 months access to this boot camp, and you get a structured lesson plan. So like you have lesson 1, lesson 2, lesson 3, lesson 4, and you click on lesson 1 and you get to watch loads of videos. It's usually me presenting on whiteboard for you, talking about the topics, illustrating it visually. So you get lots and lots and lots of videos on each topic. We update them every week. We've got new, refreshed stuff as well. There's hundreds of hours of videos on there for you to watch. It's like being in a classroom, I suppose, when you're watching a trainer talking to you about the topic with a whiteboard or flip chart or whatever. But you just don't have anybody interrupting. You know, on a classroom, you always get somebody at the back who keeps asking questions and they keep dominating the tutor's time. If the tutor's not very good at controlling them, it can get quite unwieldy. But you're watching video, you can pause it, rewind anytime you want to. Also, loads and loads of podcasts, MP3s, so you get to listen to those as well. There's tests on there, so you can do online tests. There's books you can download if you want to as well. Lots and lots of activity going on, which is self-contained. You can take as long or as short on that as you want, and people that do the whole thing, they listen to the podcast, watch the videos, they pass. They pass because we don't push you. We don't rush you. Now, on the cohort system, we do encourage you to do 3 lessons a week. And that way you get the CMAP ready within 4 months. So by the end of January, you should be done and dusted with your CMAPs. But it's slow. You can carry on doing a full-time job in the meantime. Most people have to pay the bills. The information goes in slowly. It takes you in, you embed it, you learn it, you understand it. And we support you beyond that as well. There's lots of other things we do to support you, to help you. First of all, we have our weekly drop-ins, as we call them, weekly drop-ins. Now, these are video-based, which you can drop in and you can just come on and just use the chat box if you want to ask questions, or you can come on video. Half an hour with me live on a Monday evening. You get to chat, we get to talk to you get to ask questions. That's really exciting, isn't it? You also have email support as well. So if you want any questions answered, just ping us an email. We'll get those answered for you on email, which is quite straightforward, isn't it? We also have our weekly live streams, which we're doing right now. These are weekly updates on Facebook, LinkedIn, or YouTube, where we give you updates on things that are happening in the sector, in the marketplace as well. All good stuff. There's also a group discussion forum if you wanted to use a group system inside the boot camp, which people go on there and they can talk to each other, which is lovely. Why not? You've also got a 45 minutes video call with me live on a one-to-one. That's all part of the deal. So if you've got anything to talk about, maybe you've passed your CMAP, you want to talk about your next career steps. Remember, I'm here to help you become a really good mortgage advisor. That's what I do. That's why I do what I do. That's my reason. Been in the industry 38 years now. This is my chance to pay a few bills, of course, but pay back and give you as much of my knowledge and experience as I possibly can. So what's your next step then? Well, your next step then is to go online and check it all out if you want to. If you're interested, the website, by the way, is Paul Archer, which is my name. There you go, Paul Archer, which is my name, .thinkific, which is the system we use, .com. You can go on there and you can sign up for a free little look around if you want to. Go on our website, archertrain.com, and sign up for it if you want to. It's quite easy. We're doing a webinar at the end of the month where I'm describing it in a bit more detail as well. Beyond this, we do sales training. We look after you in every way possibly we can. I'm very excited about this. Oh, by the way, the price. Well, I think it's a very good price, actually. I really do. So let's find a little space for this. This is $399 including VAT. Oh, well, there you go. So you have to sign up for the LIBF, of course, on top of that. But that's everything. That's good value. That's good value. You get a lot of value for that. And we've had a lot of people in the last couple of years sign up for this, and they're passing by the droves and looking after themselves and getting into the mortgage market. So the brand is quite strong. So we're quite pleased about that. Other than that, that's an update. Hope that's been useful. Bye. Good stuff. Okay, well, it's coming up 20 past. Hope you enjoyed the live stream today. We're coming out on YouTube, Facebook as well. If you're into the Facebook, we're coming out onto LinkedIn as well. If you're into LinkedIn, and using the Vimeo. Hope the Vimeo has been quite good for you. Hope it's worked. It's pretty good graphics, isn't it? And you can hear me clearly, hopefully. We'll be here next week for you with another update on all things mortgages, because lots of things happen in the mortgage market. But keep an eye on that long-term care thing, though. Do a bit of reading. A few insurance companies will come out with their thoughts and comments about it this week. But definitely now it's been paid for by the government, and there's more certainty about what you have to pay and what you don't have to pay. There's a cap now to your costs. You can now insure that gap, because the government will pay the rest. Insurance companies haven't been interested really, because nobody ever knows how much you have to pay, so you can't insure that. But now you know how much you're going to have to pay, because the government pay the rest. Get your insurance, get to keep the house. And if you don't pay for it, your next of kin will pay for it, because they get to keep the property rather than just sell it to pay for all those care costs. Anyway, I'm Paul Archer.